Trump faces impeachment charges, but stocks hardly budge. As if we did not have enough to worry about with the ongoing US-China trade war, the recent attacks on Saudi oil installations, Brexit risks, the volatility in US funding and repo markets, this week saw the risks of a presidential impeachment enter stage left. Now, we would point out that Trump impeachment is arguably an overstated risk. The procedural steps to a resolution in the House are long, and there is the requirement for the Senate to vote by an almost insurmountable two-thirds majority. The prospect of a more gridlocked Congress is moot. The upcoming election year was never going to see any signature legislations. While the political developments in Capitol Hill did appear to add a layer of uncertainty to markets, and the S&P is down around 1% over the last 5 days, the move's not big by recent historical standards. The improved prospect for some sort of interim US-China trade deal appears to have been just enough to distract markets from impeachment moves. China has been buying more pork and other agricultural products from the US, and high-level talks will resume on October 10. One other positive in terms of trade news is the fact that the US and Japan signed a partial trade agreement on the sidelines of the UN General Assembly, easing commercial tensions between the two countries. Importantly, the US Trade Representative Robert Lighthizer confirmed that he has taken US tariffs on Japanese auto and auto parts off the agenda at this point. However, tensions between the US and Europe may rise in the weeks ahead, with the World Trade Organization ruling on Airbus due Tuesday, allowing the US to tariff European goods, and Europe preparing a list of counter-tariffs. Importantly, Europe has not been negotiating with the US on auto and auto parts, meaning a trade war could develop in November when the US Section 232 auto investigation negotiation period expires. In the United Kingdom, Prime Minister Johnson was this week forced by the Supreme Court to reopen Parliament, though he showed little sign of humility, stating the Supreme Court was wrong to do so and claiming that MPs were trying to sabotage Brexit and surrendering to Brussels. Brexit uncertainty is thus likely to roll on well past the end of October, meaning the British pound has been one of the weaker currencies in the G10 this last week, with the euro not far behind it, making fresh 2-year plus lows. Here in Australia, the Australian dollar did flicker higher on initial headlines from the RBA Governor Lowe's speech in Armidale. To us, this was a misunderstanding of the speech, driven by Lowe's optimism that a gentle turning point has been reached for the Australian economy. He said this before, and later in the same speech, when discussing monetary policy, Lowe added that while we are at a gentle turning point and expect growth to pick up, the strength and durability of this pickup remains to be seen. Lowe also spent considerable time on the rise in unemployment and not coincidental stalling of wage growth. Moreover, he made clear that the downward pressure on global interest rates could not be ignored. To do so would mean the Australian dollar would appreciate, which would be unhelpful. Now, Westpac maintains its long-held call for the RBA to cut the cash rate to 0.75% on Tuesday, and we'd note that a rate cut is about 75% priced. So the Aussie dollar could see some weakness next week, especially with a commonly watched measure of the US dollar, the DXY index, making fresh 28-month highs. Besides the Reserve Bank of Australia meeting, we also have August readings on building approvals, international trade, and private sector credit. Now, next week is an important week in China as the People's Republic celebrates its 70th anniversary. Chinese President Xi will deliver a major speech outlining the Communist Party's achievements and his vision for the future. Chinese markets will close for the 7-day national holiday through October 7. Elsewhere in the US, we have the beginnings of the September data with non-farm payroll report released Friday. Consensus forecast for the number is at 130,000, which outside of Hurricane Harvey in September 2017 would be the lowest forecast since October 2013, emphasizing that US jobs are indeed slowing. These are all factors we'll talk about in next week's Markets Update.